Good morning, ladies and gentlemen. First of all, let me thank the organizers for inviting me to this very interesting conference. And actually, my remarks today are a bit related to both the topic of the panel, which is global financial architecture and the international monetary system, but also related to the very interesting session we had yesterday on the reforms of the IMF and World Bank. And I think this is a bit of a case study on how institutions evolve in their thinking on fairly controversial issues and issues where different parts of the membership might have quite contradictory views. So I'm going to be talking about an issue that is particularly pertinent to emerging markets and developing countries. One could also say for advanced economies, but my focus is on the emerging markets. And the issue is how to manage the volatility in capital flows, in cross-border capital flows. And this is an issue that the fund has been contending with for a very long time. And actually, if you go back to the history of the Bretton Woods Agreement and the prehistory of that, the run-up to it, there was quite a lot of discussion about the role of capital controls should play in the international monetary system. And we often think of Keynes and White, the two sort of founding fathers of the IMF, as being on opposite sides of that debate. And actually, quite interestingly, they were both in favor of some control of capital flows when they are disruptive, to somewhat different degrees, but they were both on the side of using capital controls. And actually, it was really the New York bankers who forced Harry White to change the sort of US position in the run-up to the actual agreement. And the Articles of Agreement of the IMF do envisage the use of capital controls. Nevertheless, as in the sort of post-war period, as countries successively liberalized, starting with the advanced economies, although actually many of them had capital controls up until the 1980s, something that we sort of forget. And emerging markets and developing countries also liberalized their capital accounts. I think the sort of evolving view was that liberalization and ultimately full liberalization was the goal for all countries. That sort of trend came to a little bit of a hiccup in the Asian crisis of 97, 98. In fact, at the annual meetings in 1997, the IMF annual meetings, there was an effort to try and get jurisdiction over the capital account for the IMF. In other words, just as the IMF has sort of jurisdiction on controls for current account purposes, to get the same type of jurisdiction for capital account purposes. And then we had the Asian crisis, large capital outflows, and there was a sort of halt to that process. Nevertheless, I think by 2007, sort of just before the global financial crisis, it's not too much of a caricature to say that most people thought that capital controls should be eliminated, maybe not right away, maybe there's some preconditions, but that should be the ultimate goal. Then we had the global financial crisis, and that was a kind of rude reminder that not all borrowing and lending decisions are fully rational. There are speculative excesses, there are asset price bubbles, and so forth. And so maybe we need to rethink this. And I think within the institution, there was this kind of realization that there was a bit of a contradiction emerging. On the one hand, most of us think of capital controls as impediments that should be eliminated, and if you like, capital controls are bad. At the same time, we all think that prudential measures, including macroprudential measures that Jim just mentioned, are good. Right? Nobody can be against prudence, but many of us are worried about the distortions that capital controls cause. Now, the contradiction that arises is that economically, these can be very similar measures depending upon the circumstances. So you can be against both of them, or you can be in favor of both of them, but it's a bit contradictory to be against one and in favor of the other. And I think that recognition or realizing that contradiction led to some rethinking about the whole set of issues. Now, just to be a bit clear, what I'm talking about here are controls on capital inflows rather than controls on capital outflows, which, to my mind at least, are associated with typically very bad policies, so you need to prevent capital leaving your country, or they are associated with crises where you have to stop it because of the crisis. So leaving aside controls on capital outflows, sort of rethinking about controls on capital inflows. So the IMF has been doing quite a lot of work, and both institutionally in terms of papers that the board endorses, and just research papers actually led by Olivier Blanchard, who's in the audience today, thinking through some of these issues, and I'm going to try and summarize a little bit of them. So these are just a couple of slides to persuade you that this is a burning issue. We do see these boom-bust cycles in capital flows. The chart on the right there is just showing how this kind of volatility of capital flows keeps going up over time. While we do think of capital flows as being beneficial, there are two sets of concerns that can come with them. If they're sudden and if they're excessive, there are sort of macroeconomic concerns. In other words, the country's exchange rate starts appreciating to the point that it loses export competitiveness. And that would be all right if this was a sort of permanent flow, in which case the economy should adjust to the permanently changed circumstances. But if this is a volatile capital inflow that drives up the exchange rate, businesses go out of business, and then the exchange rate comes back down and they have to sort of restart, this is a disruptive and waste of economic resources. So one set of concerns are the macro concerns. The second set of concerns are financial stability risks. And there the risks are that either banks, the corporate sector, or even households are borrowing in foreign currency, and when the exchange rate depreciates, they won't be able to repay their foreign debt. Or they may be borrowing, for example, overnight in the wholesale market, so it's a very fragile external liability structure. Suddenly the bank finds that it cannot roll over its debts, and then you have a run on the bank because the depositors want to get their money back, a little bit like what happened to Northern Rock. And finally, there may be sort of fueling asset price bubbles. Housing prices may go out of whack, the exchange rate, stock market, etc. So two sets of broad concerns: macro concerns, financial stability concerns. So as I mentioned, there were a series of papers that have been trying to kind of get a better handle on what countries should do. And I've tried to summarize it in three principles. So the first one is that countries should not try to avoid what I call warranted external adjustment. Now, warranted means necessary either from the country's own perspective, meaning in order to keep internal and external balance, to keep growth, to keep price stability, they may need to make some current account adjustments. And it can also mean warranted from a multilateral perspective. So if you think of the global configuration of current accounts and exchange rates, since current accounts globally have to add up to zero, and exchange rates, there are only n-1 exchange rates in the world, or bilateral exchange rates, countries should not try to vitiate that process using either capital controls or any other policy. When it comes to capital controls, they should not substitute for the use of available macroeconomic tools, and I'll expand on that in a moment. Okay. The second sort of principle is that both prudential measures, that's to say measures that apply to the domestic banking system, but that are not residency-based. In other words, they're not capital controls. They may depend upon the currency of the transaction, but not who is the party to the transaction. And residency-based measures, in other words, capital controls, let's say the control depends upon the fact that it is a loan from a foreigner as opposed to a loan in foreign currency. Both might be necessary for managing financial stability risks, depending upon the circumstances, and hopefully I'll have time to talk a bit about that. And third, all these policies should try to take account of multilateral considerations. So to manage the macroeconomic challenges, we should first allow the exchange rate to adjust. For those countries that have fixed exchange rates, they should not engage in sterilized intervention. And then other macro tools should be deployed as available. By that I mean they should not be prejudice the primary target of that tool. So for example, you might lower your interest rates when there's a capital inflow to prevent or to reduce the incentive for capital flows, but that should not be at the cost of missing your inflation target. Likewise, you might tighten fiscal policy, but only to the extent that that's consistent with the cyclical position of the economy or debt sustainability considerations. When those macro tools have been used to the extent that they are available, then you might think about using capital controls and or prudential measures for the macro challenges. When there are financial stability risks, those macro tools are going to be less effective in general. So your sort of first port of call is going to be prudential measures, and then there will be a choice between prudential measures that are based on the residency principle or based on the currency principle. And the choice between them depends really on the nature of the capital inflow and the nature of the risks that you're trying to deal with. So I'm not going to go through this complicated flowchart, but very simply, if we think about flows going through the domestic banking system, then prudential measures that apply to the domestic banking system might be effective. On the other hand, if these flows are bypassing the domestic banking system, for example, there's direct lending from abroad or corporates are issuing paper abroad directly, then prudential measures cannot work, and the only option, if you want to do anything, will be a capital control. Let me just touch upon this last topic of the third principle of taking account of multilateral considerations. This is obviously an issue that the IMF worries about a lot. We're a multilateral institution. And trying to think through what are the multilateral implications and what should be taken into account, what should not be taken into account, is actually quite an interesting analytical question. First, what are the potential spillovers? So if we think about a country receiving capital, and too much capital from its financial stability perspective, and it puts on a capital control, there are a couple of things that might happen. One, some people think that capital controls are ineffective, so nothing happens. The capital continues to flow into the country. If that's true, then there can't be any multilateral concern either. But let's suppose that the capital control is to some degree effective. Then there are a couple of possibilities. One is that the capital that was coming in gets deflected to some other country, or it gets deflected back to where it was originally coming from. Let's suppose it gets deflected to some other country, and that country doesn't want it either. It's also facing financial stability risks. Does that mean that the first country should not impose a control at all? Well, that's not very clear. This is what economists call a pecuniary externality. Yes, this problem might be exacerbated for the second country, but the answer is, well, that country should then impose its own controls as necessary. Now, you could imagine this process leading to a sort of escalating capital controls. And if controls are costly, then that might be inefficient and some coordination might be required. The other form of coordination that might be required is between the source countries and recipient countries. To give you a specific example, one of the concerns in the run-up to the crisis was the Swedish banks lending to Latvia. And the Swedish regulators initially were not worried about this. This was too small of a portion of the Swedish bank's portfolio for the Swedish regulators to worry about. But for the Latvians, this was a big deal. There was a lot of money coming in relative to the size of the economy. And so when they went to the Swedish regulators, the regulators said, well, this is not a problem. The Latvian says it is a problem for us. Now, eventually, the Swedish regulators sort of recognized that and internalized that and started talking to their banks, perhaps a little bit late. But you can imagine why some type of coordination between source and recipient regulators might be necessary. So let me take my minus 10 seconds to summarize. First, policies should not be used to avoid warranted and orderly external adjustment. When there are macro challenges posed by capital inflows, then you should use macro policies as available and perhaps supplement those with capital controls. When these are mainly financial stability risks, the first port of call will be prudential measures, and then the choice between prudential measures and capital controls will depend on the circumstances. The multilateral effects of these things are quite complicated, but typically we could imagine that they will require some coordination both among recipient countries and between recipient countries and source countries.
Thank you, Rex.